Welcome to the Northbound Wealth Podcast. All opinions expressed by me, my co-hosts, or my guests are solely our own opinions and do not reflect the opinions of Northbound Wealth Management. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, and tax advice or as a solicitation to offer or buy any securities. Clients of Northbound Wealth Management may maintain positions in the securities discussed in this podcast. Testing, 1, 2. Here we go. All right. So, hello, everybody. This is Brent Foster. Today is February 10th, 2025. This is your weekly market insights, Northbound Wealth Management. So, markets process tariff deals and new data. Stocks posted modest losses last week as tariff deals, January jobs data, and Q4 corporate reports injected volatility into the markets. The S&P 500 slipped 0.24% and ended Friday's session at 6,025 and change, marking its second consecutive week in the red. The NASDAQ Composite Index lost 0.53%, ending the week around 19,523 and change. The Dow Jones Industrial Average fell 0.54%, and the MSCI EFA Index, which tracks developed overseas stock markets, edged ahead 0.17%. So, on Monday, stocks opened lower on news that tariffs on Mexico, Canada, and China went into effect over the weekend. However, markets rebounded mid-morning following the news of a U.S.-Mexico deal that delayed new trade rules. News of a similar last-minute agreement with Canada followed. Stocks continued their rally midweek, led by technology stocks from companies that provided upbeat Q4 corporate reports. The S&P 500 and NASDAQ rose for the third consecutive day on Thursday, while the Dow experienced a slight fall as investors digested more corporate earnings reports. The week closed on a down note as mixed job report and cautionary inflation outlook disappointed investors. So, year to date, through the end of close last week, the Dow Jones is up 5.26%, MSCI EFA is up 6.05%, NASDAQ's up 2.52%, and the S&P is up 3.52% for the year. That's the trailing year-to-date number. The 10-year Treasury notes hovering right at 4.49 to 4.5%. Keeping a close eye on that. It's kind of nice to see the yield drop from 4.67 just a month ago. So that's kind of good. We don't like it to get up to 5 or above 5 on the 10-year. That usually signals some trouble in the equity markets, but we're seeing that trend down. So that's good. All right. As it happened several times in recent years, two job reports told conflicting stories about the state of the jobs market. On Friday, the Bureau of Labor Statistics reported that 143,000 jobs have been added for the month, a 4-year low versus a consensus estimate for 175,000 increase. Earlier in the week, the ADP report showed that the economy added 188,000 new jobs ahead of the 150,000 economists expected. The unemployment rate, however, unexpectedly improved to 4% from December's 4.1%. The rate had been expected to stay at 4.1% for January. So why do the reports tell different stories? Economists point to various factors, including how January can be a challenging month to measure accurately, typically due to the more significant number of laid-off seasonal workers. So there's a seasonal adjusted number that we look at too. Other data showed U.S. consumer sentiment reached its lowest level since July, while year-ahead inflation expectations hit their highest level since November of 2023, according to preliminary February results from the University of Michigan surveys of consumers. The survey indicated concerns regarding the negative impact of the Trump administration's tariffs policies. The consumer discretionary sector had the largest percent drop on the week, falling 3.6%, followed by a 2.1% decline in communication services. Industrials, materials, and healthcare were also in the red. Among the decliners in consumer discretionary, Tesla shares fell 11% on the week amid reports that the electric vehicle maker's sales of China-made electric vehicles fell 11.5% year over year to 63,238 units in January. Also, the U.S. Federal Highway Administration said in a letter posted online Friday that it's suspending the approval of all state electronic vehicle infrastructure development plans for all fiscal years. In communication services, shares of Google parent Alphabet shed 9.2%. The company reported Q4 earnings above analysts' expectations, but its revenue missed the street's view, prompting many analysts to lower their price targets for the stock. However, consumer staples rose 1.6%, followed by a 1.3% gain in real estate and a 1% rise in energy. Technology, financials, and utilities also edged higher in consumer staples. Philip Morris International shares jumped 11% as the company reported Q4 results above analysts' expectations. Philip Morris also forecast 2025 adjusted EPS above analysts' mean estimates at that time. In real estate, shares of Essex Property Trust, or ESS, rose 2.7% as the real estate investment trust Q4 core funds from operating surpassed analysts' mean estimate, while revenue also topped the street's view. Next week, we have a lot of earnings going on. So that earnings calendar features McDonald's, Coke, S&P Global, Cisco Systems, Applied Materials, and Deere and Company. Economic data will include two closely watched inflation figures, the Consumer Price Index and the Producer Price Index for January. There will also be reports on January retail sales, industrial production, and capacity utilization. All right. Tax tip of the week: beware of ghost preparers. Ghost preparers don't sign tax returns they prepare, which is unethical and illegal. All paid preparers must sign and include their preparer tax identification number, or PTIN, on the return. And if they don't, this is a big red flag. These preparers might also promise unrealistic refunds or charge fees based on the size of the refund. The IRS also has a page on irs.gov dedicated to helping taxpayers choose a reputable tax professional and a directory of federal tax return preparers with credentials and select qualifications. No, this information is not a substitute for individualized tax advice. Please discuss your specific tax issues with a qualified tax professional. This tip was adapted from irs.gov. Stay tuned for the next segment. Even though we're financial professionals, we care about more than just the financial health of the families that we serve. February is American Heart Month, and the 2024 statistics from the American Heart Association underscore the importance of an investment in our heart health. So, cardiovascular disease accounts for nearly 1/3 of all deaths globally. Every 34 seconds, someone in the United States experiences a heart attack, and 80% of premature heart disease is preventable through lifestyle changes. So, just as we advocate for proactive personal finance, we encourage you to stay vigilant with your health of your heart and prevention strategies. A strong heart is the foundation of a truly rich and fulfilling life. So, here's to good heart health and a good 2025. Also, I don't want to forget to mention February is also National Cancer Prevention Month. So we're talking about your heart, and then we're also talking about cancer. So during this month, we all recognize the profound impact cancer has on our communities and the power we hold to make a difference. The statistics are sobering, yet they underscore the importance of our collective efforts. In 2024, an estimated 2,001,140 new cancer cases and 611,720 cancer deaths were projected in the United States, according to a 2024 report in the National Library of Medicine. Early detection significantly improves outcomes. Localized breast cancers have a 99% 5-year survival rate compared to a 31% for metastasized cases, according to the 2024 report by the American Cancer Society. These numbers represent not just statistics, but also families, friends, and neighbors, many of whom we serve in our practice. Check out these proactive tips and steps. Schedule regular checkups and screenings, support loved ones undergoing treatment, and contribute to cancer research and patient support organizations. As financial professionals, we understand the importance of preparing for the future. this month, let's extend that foresight to our health and well-being of our community. Hello, everyone. This is Brent Foster, and this is your technical analysis update. I like to update us and everyone on the McKellen Summation Index, New York Stock Exchange. And I'm looking at the full stochastics, the 5, the 3, and then the 14 and 3, and then the daily chart of the New York Stock Exchange, as well as the S&P 500 index overlaid with that, and volume undefined. So I get to see multiple levels of study in one chart and an oscillator, and it updates. I got it on a 1-year range. Period is daily, and it updates like once every week. So it's not all the time that I update it and look at it. The data shows that we're in a bull market uptrend, which is reflective of stock market price. The internals of over the last, since October, November, December have kind of gone down on this particular study from about a little over 1,100 down to negative 400, and then we're back up to 206. So the trend has reversed and gone back up. Price has stayed up. It's trended down a bit, but has stayed up. The equity markets are showing that they're very resilient right now, despite the Mag 7's lackluster performance. That's the way that I'll put it. So we're nearly at 100 and 100 on the full stochastics, both data sets. That's my third indicator. I'm going to go to the fourth indicator that I look at, which again, is a study, but over a weekly period. So kind of zooming out, and it looks like over the weekly, we're trending higher up towards that 100 marker that I like, but we're not quite there yet. We're at like kind of a midway point on the longer full stochastic. On the shorter full stochastic, which is the 5 and the 3, we're a bit higher towards that 100. So it's at 99.0 on the black line and 72.62 on the red. On the longer stochastic, we're at 54.81 and then 34.21. So we're kind of towards that midline. So price on the S&P 500s continue to trend higher. So that implies that it's thinlier traded, thinlier represented, but still trending in the right direction. We're definitely in a bull market, and you're seeing that S&P 500, New York Stock Exchange, and NASDAQ resilience. Okay. NASDAQ has trended down a bit year to date relative to the Dow and the S&P, but that's okay. It's actually okay that that happens. I'm happy with that, actually. So let's look at the bullish percent indicator. I like to look at this one, 56% bullish. So even though we're trading on the S&P at 6,066 and change, we have 56% bullish. Okay. So you can look that up in a chart by $BPSPX. So of the S&P 500, 56% bullish. Okay, let's take a look at another indicator on our charts. Let's take a look at where the VIX is at. It has trended down. And I've got a daily chart of the VIX over, I don't know, I've got the moving average of 10, 20, 50, 200. And I like to look at multiple studies, kind of overlay those charts. And I'm going back all the way into 2024, about 6 months to a year. And we're looking at a VIX that is trading. I'm waiting for the VIX to show up on the Bloomberg terminal. Oh, and a VIX that's trading at 15.76. That's down 4.72% on the day. Today's February 10th. So keep that in mind. A VIX around 15 means things are pretty normal. All right. Now let's take a look at the SPX, or the S&P 500. Percent of stocks above the 50-day moving average. And we've got around 50 to 53% of stocks trading above their 50-day moving average, with the RSI that hit kind of a bottom at the very beginning of the year, end of last year, beginning of the year. The oscillator on the RSI 14-day relative strength index was below 30 by far. That would have been a good buying opportunity. Now we've got that particular oscillator touched about 70 and then has backed off to 54.75. So I'm taking a look at that as an indication. We're at like the midline on the slow stochastic 100. Okay. MACD 12, 26, and 9 has trended down. We've got the exponential moving average moving below the slower exponential moving average. So that'll be interesting to see if we get a bit of a tap and then a move higher. It looks like momentum and volume has kind of was at a peak here towards the mid to end of January. We've trended down into the early parts of February, even though price is king, right? Price trumps time and price is up. And that is pretty indicative of bullish sentiment. All right, let's take another look at other market indicators. Stay with me here as I pull up another screen. And for those of you who don't understand technical analysis, that's okay. Don't have to understand all of this stuff. And if those who do, have fun with this as I look through the equity put call ratio. I like to look at that one. I have a period of a daily, range of 1 year, symbol is $CPCE, and I have multiple studies, including RSI, MACD, full stochastics, and 50 and 200-day moving average along with volume. And so it's looking like a lot of protection has come off in recent days, beginning of the month, and I imagine that protection will go back on, and that we have positive divergence when it comes to this particular chart, and we'll see that 0.593 is the 200-day. We're at 50-day is 0.544, and then where we're trading is 0.52. So not a lot of protection put on yet. I would imagine that would spike up higher as the equity market's price is hanging in there and moving higher. So whenever you see protection coming off, that means that markets should rip higher. VIX is dropping, markets go higher. And despite the Mag 7 not actually carrying the market, so that implies broadening out in the equity markets. And that's a good sign across other sectors that might see the contributions and attributions of artificial intelligence, chips, maybe some efficiencies in their productivity, which means over the course of the year, they might actually make more money and be more profitable. So I think that that's a good sign across the board. The fact that the equity markets are being as resilient as they are in the face even of inflation that is kind of sticky, around 2.9, 3%. The Fed keeping rates high and Trump doing his tariff thing. It's, despite it all, the market's resilience, the consumer's resilience, the data and the economy, boy, looks pretty good. Looks pretty darn good. Okay, that's all I got for the technical analysis spotlight this week. I'm going to talk about Apple, NVIDIA, and a lot of the Mag 7 coming up in the next week podcast. So stay tuned for that and have a great week. Have a great weekend, and we'll talk to you soon. Thanks for listening. Take care.